the Fed can't fight the market forever. Basically, rates want to be lower, and they've wanted to be lower for a while now, for a few years now. But the Fed has effectively artificially propped up the front end of the curve because the 2-year Treasury yield is essentially the market's reflection of what the market thinks SOFR, or the Fed funds rate, is going to average over the next 2 years, right? So if the market forces which influence Treasury yields, which is inflation, growth expectations, and global capital flows, if those point to lower rates, but the Fed is just keeping rates high, there's going to be that fight, and that's what's resulted in an inverted yield curve, where the long end, which is based on market dynamics and bond trading, setting lower rates, but then the Fed is keeping rates high for longer. That's how we have the inverted yield curve. And now the Fed kind of has to acknowledge that the market is in fact right. Growth expectations are lower, inflation expectations are lower, and there's a flight to quality, which means Treasury yields go down. They too need to go down. That's the interesting dynamics of what's going on as far as the Fed lowering rates, and how that may or may not impact Treasury rates, which then may or may not impact your rate. Furthermore, like you said, lenders, with their nasty terms, they have floors. And a floor is basically the lowest that your fixed rate can go before you lock the rate. So, for example, just to paint a really simple picture, you might have a loan where it's based on the 5-year U.S. Treasury yield, which is at 3.5% today, and then you have a lender spread of 1.5%. So your rate, if you were to lock today, is 5%. However, lenders often put in a floor. So let's say the floor is at 3.25%. And what the floor means is, as rates fall, if they're falling, if you go below the floor, you basically get stopped out, and you're not going to benefit anymore from falling rates. And when you do lock your interest rate, even if treasuries are 3%, you're going to use the floor of 3.25 plus your spread of 1.5. And so you'll be at 475 on your all-in rate. So it's important to try to negotiate those floors in a falling rate environment, which I do believe we are in a falling rate environment.